All right, we're going to go ahead and get started, everybody. Good afternoon. My name is Ryan Melliker. Hopefully, you guys are on here for a good reason, and you know where you are. This is the Lodging Analytics Research and Consulting 1Q-2022 Market Intelligence Reports Release Presentation and Webinar Outlook for the U.S. industry. Before we get started, a couple key points that I'd like to highlight. Number one is this is being recorded, as you guys may have heard that it just came up. As such, hopefully I didn't just lose everybody. So number one, this is being recorded. So if you have an issue where you have to pop off, don't worry about it. We are going to, it's not a problem. We will go ahead and get this posted to our website by early next week. Number two is if you're interested in the slide deck, we will send it out to all participants after the session. And then number three is there is a Q&A button in your menu. You can lob a question in. We will save some time at the end for Q&A. And with that, I am going to go ahead and get started. So this is our agenda for the day. Or the next hour. We're going to walk through our approach. I think understanding our approach will give you some confidence into how we get to where we get to. It's not just about the numbers that we present, but it's also why we feel the way we feel. We think that's very important. Our review of where we are in the recovery and how things are stacking up, why we think this recovery is different and will continue to be different, an overview of the U.S. outlook, and then some market highlights over the next few years, followed by Q&A, as I mentioned. So with that, I'm going to dig in. I'm probably going to cruise through this pretty quickly. As a caveat, my apologies if I pause for a cough or a sneeze. I unfortunately did test positive for COVID-19 on Tuesday. Feel fine, thank you. But do have a little bit of a cold. So just as a heads up, my apologies in advance. All right, that being said, we're going to dig into our approach. So our core product is what we refer to as market intelligence research. We do a lot of market intelligence research and consulting for our clients. And when we think about a market, we want to analyze everything that drives a market. And we want to put it all in one place and make it easy for our clients to be able to understand what's going on in the market and how it's going to move the area's lodging performance going forward. Things like historical operating results, a detailed economic overview and outlook, citywide pacing data, air traffic, the office market, supply, short-term rental impact, recent transactions, and then key capital projects, both public and private. Public being things like convention center expansions, airport expansions, new infrastructure like subway lines, new museums. Private being major real estate developments that we think are going to impact demand, maybe shift it from one location to another, create new submarkets, et cetera. And then we take all of that information and we issue forecasts for all of these metrics. It's not just the typical supply, demand, OCADR, RevPAR. We actually forecast for 44 markets around the country, wages, hotel Ebitda, property taxes, cap rates, and values looking out 5 years. Our core values are important because it resonates throughout everything that we do. Transparency is the paramount to what we do. Every time I hear a forecaster talk about a black box, it just kind of frustrates me. The only reason somebody tells you that it's a black box, there are three reasons. Number one, they don't understand it. Number two, they don't think you'll understand it. Or number three, they're afraid you're going to understand it and not like what you see. So to us, transparency is a value add. We think we want our clients to understand how we get to our numbers as opposed to saying, trust us. Just because we haven't been right before, don't worry, trust us anyway. That's always a great recipe for success, right? That's not our approach. We are market-based. Like I mentioned, we issue reports and forecasts for 44 markets plus the US overall every quarter. Out of all 44 of those markets, no two have the same drivers. After all, at the end of the day, the drivers of the New York hotel market are different than the drivers of Miami, which are different than the drivers of San Francisco, which are different than the drivers of Phoenix. If every market had the same drivers, they'd all have the same performance, right? Or at least similar performance, but that obviously is not the case. So understanding the nuances of the different markets and being able to build out models that are market specific is where we thrive, and that's our bread and butter, and that's what we do. And the last thing I'd say is we are very data driven. We are realistic in nature. We don't sugarcoat, we don't adjust, we don't compromise our outlooks. The data says what the data says, plain and simple. We tried to provide baseline forecasts that represent the most likely outcome given everything that we know today. As what we know changes, the outlook will change. But based on what we know, we're giving what we believe is the most likely outcome. And then if you have a different assumption, fortunately, we provide sensitivity tables on what different assumptions on some of our core drivers would actually do for RevPAR and ADR and values and things like that. So that being said, our forecast methodology is very, what I would call, not rocket science, statistics 201 type stuff, multivariable linear regression forecasting. What makes us unique is that we actually build models by market and make them as accurate as possible. So we don't need to make subjective adjustments. Every time I hear about subjective adjustments to a data model, I always think that's not a data model anymore. That's simply a subjective, your gut feeling. This is your forecast, your gut. And when I hear about peers out there that make subjective adjustments and use the example of a Super Bowl as to why they make subjective adjustments to a market, it makes me cringe, because I'm sitting there thinking, we know what Super Bowls do to a market. I think everyone on this call probably knows what Super Bowls do to a market. Can't we build that into a model somehow? Yes, we can. We actually do. We build things like Super Bowls, college football championships, Final Fours, all into our models, so we can better forecast for those things. Inaugurations, hurricanes, you name it. We can do all of that. So when our peers out there say they make adjustments for those things, it highlights how inaccurate their models are, or at least incomplete. And then the last thing I'd say about our methodology is, we've all heard the term garbage in, garbage out. Same thing, better data in equals better data out. As you guys build out your underwriting assumptions and your outlooks for your individual assets or deals that you're working on, you want to incorporate the best data. We want to do the same. We have scoured the earth looking for the best data providers for us to do to create our product. Historical operating results, we use STR. We believe they are by far the best. They are the industry standard in terms of historical operating results. Colibri does a lot of great work. I don't have anything negative to say about Colibri, but when it comes to building data models, Colibri's data only goes back to 2014. Building a data model back to 2014 isn't that helpful. You're basically less than a full cycle. That creates a challenge, and Colibri's data isn't quite as complete as STR's. So we prefer STR. Detailed economic forecasts. We use Moody's Analytics. This is Mark Zandi's company. It used to be referred to as economy.com for those of you that are familiar with that. Highly regarded. Mark Zandi is a highly regarded economist. He's been on Bloomberg or CNBC basically every week talking about his economic outlook. The other big player in that space is Oxford Economics. Oxford does good work too, but having dug into the work, we really like Moody's more. We think they do a better job at U.S. metro level forecasting than Oxford. Oxford owns Tourism Economics. Tourism Economics does forecasting for STR, and one of our other peers, CBRE, uses both Colibri and Oxford. We believe inferior data leads to inferior results. That's our view, and you can argue that and our view, and we think we have the best data providers. Citywide pacing data comes from local CVBs. Office market data comes from Moody's. Moody's owns a commercial real estate data firm called Reese. Supply pipelines, whether it's STR, Dodge, CoStar, lodging econometrics, lodging development, Build Central. We don't love any of them. We think they all involve a lot of work scrubbing the data. We find a ton of redundancies, a ton of errors, a ton of challenges. We start with Build Central. We like them the most. We layer in some we layer in some data related to CoStar, and then we scrub the data and scrub it again and scrub it again. We put about 500 man hours in every quarter, making sure that we've got a supply pipeline for the 44 markets that we track that is accurate and correct at that point in time. And then short-term rentals we get from AirDNA. Historical cap rates come from Real Capital Analytics. For transaction color, which does not drive our models but goes into our reports, we use data from our peers, our partners at LW Hospitality Advisors. Note that none of our model driver data providers are affiliated with us. We have cherry picked what we believe are the best, as opposed to something that's convenient, which I think is a differentiating point. And fortunately, it shows with our client roster. We've only been in business for a little over 2 years now, and I am proud to say that anybody that has bought a report from Lark has bought a second report from Lark. Anybody that has signed an annual contract that has been up for renewal has renewed that annual contract, literally batting 1,000. And this gives you a sense of what our clients think about us. They really love the work that we do. And it runs the gamut from Wall Street firms to global private equity to lenders, brokers, brands, third-party operators, you name it. Basically, anybody in the space finds value in the work that we do, and that's exciting for us. With that, I will stop there and get into our US market overview. Um, So this is monthly US growth relative to 2019 levels or pre-pandemic levels. And what's interesting is I'm going to focus on the light blue line here. You could see light blue line, which is ADR, started to recover, and then boom, July of 2021, ADRs were above pre-pandemic levels. And check it out. They actually stayed above pre-pandemic levels through the end of the year, but then dipped down in January 2022 related to Omicron. Fortunately, we estimate that in February, they have now bounced back and back above. So basically, 7 of the last 8 months, ADR is above 2019 levels, effectively meaning that ADR has already recovered, not on a trailing 12-month basis or on a calendar year basis, but we estimate that the first calendar year where ADR is above 2019 levels will be 2022. And ADRs are basically back already on a nominal basis. If you look at RevPAR, which is the gray line here, it popped nicely by July 2021, but then started to dip back down. Again, this was the heavy leisure exposure over the summer. Dipped back down, picked back up in December, and then cratered related to Omicron in January 2022, and it started to come back. And then occupancy, similar story, just not quite as extreme as RevPAR. So bottom line here is that things were looking really good going into year end. December looked great. Obviously, it's 1 month and there's noise associated with any single data point. But we were starting to feel pretty confident in late November, early December, which was when our last forecast came out. Omicron took a little bit of a hit related to that, which you see here. But the good news is that hit was very short-lived as things are starting to bounce back already, which is nice. If we look at 2021, one of the things that we like to highlight is that this is a very inconsistent recovery. What's happened across the US is not indicative of what's happened across every market. Across the US, RevPAR was down 17% from 2019 levels, right? But take a look at this. Markets like Charleston and Virginia Beach were actually up close to 10% relative to 2019 levels. Obviously, very leisure-heavy drive-to markets, but even markets like Omaha, particularly strong. And then all the way at the other end, San Francisco down 65% from 2019 levels still. But if we fast forward to a point in time, let's take a look at that December metric. Remember, December was kind of that one point in time. We ended the year, things were looking pretty good. Was it looking pretty good across the board? Not quite. Like we said, RevPAR was up 5% versus December 2019, but 24 of our 44 markets, a little over half, actually had positive RevPAR relative to 2019. The market divergence, unfortunately, remained extreme. Tampa up 24%, San Francisco down 41. So it just kind of goes to show you, where you are really matters. Market performance is very, very important. And it is very different from one market to the next. The other thing I'd highlight is it's not all leisure markets that are performing well. If you take a look at a lot of these markets that were up relative to 2019, you've got Pittsburgh, you've got Dallas, you've got Dayton, Ohio, Omaha, Nebraska, Cleveland, Kansas City. Obviously the ones that are strongest are very leisure oriented, but there's a lot of markets that aren't so leisure oriented that are still performing well relative to 2019. And a lot of that is because of ADR strength. So if you think about ADR, this is 2021 ADR versus 2019. Paints a very similar picture to what we saw with RevPAR for the full year, except ADRs weren't down quite as much, right? For the full year, ADRs were only down 5% across the country. Only 5 of our 44 markets had positive ADR relative to 2019, but the market divergence remains extreme. Miami was up 14%, San Francisco down almost 40. But then if you fast forward to that point in time at the end of the year, December, here's what we saw in December. You saw 31 of our 44 markets actually had ADRs above 2019 levels, and US ADR was almost 7% above 2019 levels. Market divergence, again, remained extreme. Miami, New Orleans, Las Vegas, all up over 20% in ADR relative to 2019. San Francisco and San Jose still down over 20% relative to 2019. And again, if you look through some of these markets, it is not all leisure. Here's Pittsburgh right here, one of the strongest markets. You've got Cleveland right here, LA, Kansas City, Atlanta, Indianapolis, Omaha, Detroit, all above 2019 levels. Dayton, I can keep going. And I think that's what's indicative of of this recovery is leisure is the strongest, but leisure is not the only thing recovering, especially when it comes to pricing. Pricing has been much more resilient and has snapped back much faster. And we'll get into why in a little bit than we've seen in past recoveries. And it's across a variety of different markets, whereas some of the largest markets continue to face some of the biggest challenges, as you see down here. Now, as we think about the recovery from Omicron, this chart gets kind of interesting. I'm going to focus on the far right of this chart. This is air traffic throughput on a rolling 14-day average. And what you see basically is that in late November, throughput volumes had recovered to within 12% of 2019 levels. So we were on our way to a strong recovery. The momentum looked pretty good. But then Omicron, December started to pull back. January really took a hit. And by late January, throughput volumes were 26% below 2019 levels. However, that was where it troughed in late January, and things have started to bounce back. And look at where we were by early March. Throughput volumes were back to within 12% of 2019 levels. So we're starting to feel pretty good. That momentum looks really good. We feel like there's going to be some strong growth into March, April, and May, which hopefully will lead to a full recovery in the near term, barring any more variants and other challenges. Hotel booking volumes, and we're getting a very similar story here. If you look, booking volumes in November if you look at this chart right here, the top line is the US, the bottom line is global, and this is data from SiteMinder. You can see in mid to late November and leading into Thanksgiving, you saw booking volumes that had approached 8% of 2019 levels. So really close, right? But then they started to fall off. Part of that was after Thanksgiving, and then part of that and then there was the Omicron variant. And in mid-January, they had troughed at almost 40% below 2019 levels. So a big pullback, right? But then from mid-January forward, we have seen a steady climb, and they peaked right heading into the President's weekend, February 22nd, 94%, only 6% below 2019 levels. Obviously, we've seen a pullback from the holiday weekend, but generally that trend line looks pretty good. And we think we're seeing things continue to improve. Booking windows have also started to lengthen. They remain short, but they are lengthening, which is encouraging. It tells you that people are less focused on, well, can we travel this weekend, or are we worried about a new variant or COVID materializing over the next 2 months. They're not as worried about it. They're starting to say we're going to do it anyway. And I think that's a big change in psychology than what we saw before. It's only on the margin right now, but it is growing, and that's encouraging. Then this slide I think is always interesting to highlight to people. I'm going to focus on this bottom chart here. This is the hotel comparable short-term rental segment share of total accommodations revenue across the US. Hotel comparable is whole unit, studio, 1-bedroom, 2-bedroom units. We're not talking about the 7-bedroom beach house, and we're not talking about the guy renting out the couch or the spare bedroom. We're talking about the whole unit, hotel comparable property. And what you see here is basically we saw a steady increase in market share. It spiked at the depths of the pandemic because hotel revenues created, and then things started to fall back down. And if you look at where we are now, we're basically right where that trend line was before, at around 4 to 5% market share. Probably not that surprising. As we move forward, one of the big factors that's obviously going to drive market share is going to be revenue growth. And take a look at the year-over-year revenue growth, rolling 4-quarter average. You're seeing a big spike right now. It's starting to grow pretty aggressively. That highlights the strength in leisure, not too surprising. But what's also really interesting is this line, and this is supply. If you look at this line, which is the rolling 4-quarter average of available inventory for short-term rentals, and compare it to this line, they look awfully similar, right? They look awfully similar because the biggest driver of revenue growth is supply growth. It's not ADR, which looks nothing like it, and it's not occupancy. It's all about available inventories. So to the extent available inventories across your market change, it will impact your short-term rental revenues, which of course will impact market share and potentially hotels in that market. Therefore, understanding what will change the short-term rental inventory is incredibly important. That's why we spend a lot of time talking about the regulatory environment for short-term rentals, because there are environments where short-term rental regulations are getting much stricter, which is good for hotels. And several places where the state is trying to take control of short-term rental regulation and banning all existing local short-term rentals, which at least in the short term will translate into no regulation and the pullback of regulation, which will likely lead to a spike in available inventories. Knowing what's happening in your market is important. Please pay attention to it. If you need our help with that, just let us know. So let's move on to why this recovery will be different. So let's take a look at the timeline. And I think this is kind of interesting. The dark blue line here is the current recovery, is the current cycle. You can see that we fell much farther than anybody else than the prior two cycles, but our recovery has also been much steeper. And if you look at where we are now in terms of RevPAR, we've already eclipsed where we were at this point coming out of the great financial crisis. And our momentum is only growing. And this is on a trailing 12-month basis. So that's very, very encouraging that, from the start of the decline all the way to where we are today, momentum is strong and we've already bounced back that much. We're not saying that this is going to go straight up, but we do feel pretty good that, this recovery has a lot more momentum to it than the one coming out of the last cycle did, or even the one before that. Occupancy, similar story, not quite as robust as RevPAR, but very good. We're slightly below where we were in terms of the occupancy recovery following the great financial crisis. And then ADR, again, we're better. ADR looks particularly strong. So at the end of the day, this recovery seemed, while very V-shaped, as you can see with this, it's also very encouraging where we are today versus where we were in past recoveries and the momentum that we have behind it. When you think about values, this is all historical, and we'll get to the forward look in a moment. But if you think about hotel values, values peaked in 2018. And in 2018, they peaked 18% above the 2007 peak. But from 2007 to 2009, they dropped 27%. It then took another 6 years to 2015. So that's 8 years after the prior peak to get back to 2007 levels. Well, fortunately, the values kept going up and they peaked again 18% above. We estimate values peaked in 2018, dropped in 2019, and then further dropped another 24% in 2020, and started to recover in 2021, up another 22%. But across the country, are still about 7% below 2019 levels. There are obviously markets that are higher than 2019 levels, and some markets that are much worse than that. By 2022, we think values are fully recovered, and we'll get to that in a second. Convention demand. Here's something that's kind of interesting. So we track 30 of the largest convention centers around the US, and we've aggregated definitive room nights across them. And what you'll see is that 2022 is actually pacing up 95% from 2021, and it's 16% below 2019 levels. 23 and 24 are continuing to improve, right? As is 2025. And the bottom line here is that we've seen this strong recovery in 2021 without group. What happens in 2022 when we see group? We think that's really positive, and we're going to see a lot of group come back in 2022. And anything that doesn't come back in 2022 is going to make its way back in 2023, based on where these definite room night bookings are. So, barring any massive shift related to, a new variant that causes more cancellations, which is not in our assumptions, we generally believe that convention business is coming back very quickly, certainly faster than we've seen in any other recovery. Moving on, gross savings rate. This is always interesting to take a look at. So gross savings rate is a great indicator for ability for leisure travel, and it doesn't mean to say it doesn't indicate desire for leisure travel, but it does indicate ability for leisure travel. And when you think about ability for leisure travel, gross savings rate, very relevant. And what you see is that we're at an all-time high, right? Or we are at an all-time high in terms of gross savings rate. We're over 2 times where we were after the great financial crisis. And unlike during the GFC and 9/11, where gross savings rates declined, it's actually grown. And one of the reasons it's grown is because of the fiscal stimulus that has come out of this recovery. And we think all of that is very positive for leisure travel over the near term. When you think about corporate transient travel, we want to talk about economic activity. And when you think about economic activity, a lot of times we hear about GDP growth in aggregate across the country. And while that's a great metric, I think if you look at how if you break it down by sector, you get to a very different view. GDP was strong in 2021, right? Growth was up. 2020 wasn't as bad as people had really thought it would be. Great. But let's break it down to the sectors that really matter for corporate transient travel. And that's IT, financial services, professional and business services, and to a lesser extent, government. IT is actually 14% above 2019 levels. Financial services over 8% above. Professional services 4%, and government 2.5%. When you see that type of of strong revenues relative to where we were pre-pandemic, that's an incentive to travel, and that's positive. The other thing that's an incentive to travel is the stock market. Hold on one second. When you think about the stock market, and I know there's been a lot of volatility over the past couple of weeks. I'm not going to talk about the volatility and the noise. We're not focused on what's happening from day to day or week to week. We're taking a more moderate view. In 2021, the S&P set an all-time high and was actually up 27% year over year. That came after a 15% increase in 2020. Did you hear that? 15% followed by 27% during a pandemic. Now we know it's pulled back year to date, but nonetheless, when you're looking at valuations across the stock market that are at all-time highs, you have to, multiples are high. You have to grow into those multiples. You can't cut costs into a multiple. Nobody cuts costs into a valuation multiple. It doesn't work. You don't get paid to cut costs. You don't get a valuation premium by cutting your costs. You get a valuation premium by being able to show you can grow your revenues. And that's exactly that's exactly what's going to happen coming out of this recovery, with corporate transient really accelerating their travel. And that compares very differently to what we saw in the past couple of cycles, where the stock market came out much worse off than what we're seeing now. So all of these are the reasons why we're seeing that V-shaped recovery that I talked about before. You got strong group, you got strong leisure, and corporate, which hasn't really started meaningfully yet, is the next leg, and that's exciting. And then the last factor that I think is really interesting is fiscal stimulus. Now, I won't spend a lot of time on this slide, but our fiscal stimulus is staggering. 6 times what it was after the great financial crisis. In our assumptions, we've got another 1.2 trillion coming later this year related to the social spending and climate bill. Whether that gets passed or not, we don't know, but that's an assumption from Moody's Analytics we incorporate into our assumptions. But just take a look at that. That's where we are right now versus where we're in the great financial crisis. And one of the big drivers, and we also believe that's one of the big factors driving inflation. So as we think about inflation, it's important to understand, what is the real impact? And to us, it's not what you may think. There's this intuition that inflation is good for hotels. We generally agree, but the data doesn't really give us the same warm and fuzzy as our general view. So if you look at, there hasn't been, and one of the reasons the data doesn't give us that warm and fuzzy is there just hasn't been enough data. STR started tracking data, hotel industry back in 1987. We haven't had a lot of years of elevated inflation since 87. So if you look at from 87 to 2020, we don't want to include 2021 because that's kind of an anomalistic year. While inflation was elevated, we're also recovering from a pandemic. So those two things don't always, you can't really isolate one from the other. But what we're seeing basically is that there was a 36% correlation and a 13% R square. So those numbers aren't great, but it does say that there's some type of relationship. But more importantly, when we look at the years where inflation was above 3%, so we're not talking about high inflation, but moderate inflation since 1988, in those 10 years, there's actually a negative correlation between inflationary change and ADR and RevPAR, meaning that inflation goes up and ADR and RevPAR go down. So that would not be what you would intuitively expect. Now, again, these are moderate inflationary years, but it highlights that it's not a strong driver of ADR. That doesn't mean it's not relevant. It's just not a strong driver. Much stronger drivers are going to be supply-demand dynamics. And that's what you want to focus on when you're thinking about where your pricing power is going to come from. It's not inflation. And then the other side of things is the expense side. 84% of the average hotel's cost structure is related to items that are impacted by inflation. That means that as inflation goes up, expenses are going to go up, which means that if ADRs don't go up, that's a challenge, right? What's kind of interesting is that hotels that union hotels, which are normally more of a less desirable operating structure for at least hotel investors, may look more interesting right now because you've got fixed costs or more fixed costs. Your labor costs are more fixed than a non-union hotel because you're capped at what your increases are, and all that's contracted. So that gets interesting. The other thing that would be interesting are hotels that don't have a high cost structure. If you're able to run a leaner model where you don't have a lot of costs, your expense impact is more limited if it goes up. And the last thing that I think is worth highlighting to everybody is the relationship between cap rates and inflation. Intuitively, it makes sense that as inflation increases, there would be a flight within the investment community into hard assets. We see that all the time, right? And even more so to hotels because of the perception that there's a positive relationship with ADR since you can reprice daily. If you look at the data is similar to what we see with ADR in that there is a 30% negative correlation and an 8.8% R squared. Not a big relationship, but it's there. So we would like to think it's marginal. But unlike ADR, what we see in the 11 quarters where inflation was elevated since 2005, cap rates have actually compressed about 20 bips. So in that environment, it's pretty positive. Highlights that as inflation goes up, cap rates do in fact compress a little bit. So that should be a positive. So bottom line, as you see right here, is that we think hotels benefit on the margin from rising inflation, but those with the lower fixed cost structures will benefit more. Now, we'd be remiss if we didn't have a slide talking about the war in Ukraine. And I think there's two factors that we need to highlight: the direct impact and the indirect impact. The direct impact is how the Russian economy is going to play out for the U.S. and U.S. feeder markets, right? The good news is the U.S. has minimal exposure to the Russian economy. The bad news is Europe has substantial exposure to the Russian economy, and especially Russian oil and gas. And the economic sanctions on Russia are likely to take an outsized hit on European economic growth. And if the war continues to progress and sanctions don't get removed, which doesn't seem like they will anytime soon, that's going to weigh on European economic growth. And if that weighs on European economic growth, it could very easily weigh on inbound international travel from Europe into the US. And that's going to impact certain markets more than others. Believe it or not, there's not a lot of Germans traveling to, Detroit or, Minneapolis. It's going to be New York, Boston, DC, Miami, Chicago that get hit the most. So that's just worth keeping an eye on. The indirect impact is related to the cost of oil. Oil prices have spiked. They've been extremely volatile. They're up one day, they're down massively the next, up a lot the day after. Sustained high oil prices can slow economic growth. We haven't gotten to the point where we have sustained high oil prices and high gas prices yet. Doesn't mean to say we won't get there. We very well could. A lot of it comes down to how long this war really persists. It's already begun to weigh on the stock market, which obviously impacts the economy as well. What it will also do is likely lead to more U.S. oil production as oil prices stay elevated, which is positive for markets by oil and natural gas production, as well as markets with outsized exposure to the energy sector in general. Houston is the major market that we think of that's in that space. Obviously, Tulsa is another one. We just submitted a report to a client for a couple markets in West Texas, where we quantified the impact of oil prices on RevPAR, and it was staggering, the relationship. So there are certainly some markets where that can be a pretty big positive. Our view on oil is nowhere near as positive as what we've seen recently with $115 a barrel. We don't think that's sustainable, but we do think that oil is probably at a level and has been at a level now. And the outlook is positive enough now that you'll see more and more energy companies re-engaging, turning their rigs on, starting to do more hiring, beefing that up. And that's very positive for those types of economies. And if you think about it, those types of economies really peaked in 2014 and have really been struggling ever since. So there's a lot of growth that can come from this point forward. The impact of a higher oil price and higher gas prices on national demand. This is something that I always think, people ask all the time about, well, isn't gas a really big driver of hotel demand? Gas prices a big driver of hotel demand? Generally, the answer is no. There are certain markets where it is, but it's not one of our big drivers. If you look, there's a 45% correlation and a 20% R squared between oil prices and RevPAR, going back to, or oil prices and, I'm sorry, demand, going back to 2000. That should say demand. There's a 55% correlation between demand and gas prices. So you're talking about, there's a meaningful component, but it's not like this huge driver. And the biggest reason for that is if gas prices are elevated, if there are other factors like a gross savings rate that's at an all-time high, people are still going to travel. Maybe they just don't drive 5 hours to get away for the weekend. They go an hour away. It doesn't change demand; it just shifts the demand from one location to another. So if you're looking at a resort that's drive to 5 hours from the locust population center, yeah, that hotel may struggle. But if you're looking at a hotel that's an hour away from the population center, it's probably not going to have an impact. And if anything, it's a positive. So it more moves demand around than it does have any massive impact. Though we do think on the margin, it would probably be slightly negative for drive to leisure destinations. But again, only marginally. And we think that gets offset by the incremental positive with outsized exposure for those markets that have outsized exposure to energy, like Houston, West Texas, and Tulsa, as I mentioned before. Okay, so that being said, let's dig into our US outlook. I know you guys are all excited to walk into this. So our key assumptions, I talked about the $1.2 trillion in our Build Back Better program. We assume the Fed raises rates 4 times for 25 basis points a time beginning this month. We think elevated inflation and labor supply constraints will ease. There's no new variants that will impact children or the vaccinated in any meaningful way. And the Russia-Ukraine conflict does not lead to military involvement from the US or the rest of Europe and ends in relatively short period. Return to office. This is kind of an interesting thing. In past quarters, I've had a nice big chart here that shows you every company that's identified their return to office date and what's been going on. And what's fascinating now is that between, most companies had a return to office scheduled between October 21 and January 22. But between the Delta variant and the Omicron variant, every company that planned their return to office has postponed or canceled their plans. And in every large company, I should say. And in most cases, new dates have yet to be announced or communicated. The reality is, I think the variants have caused management teams to really try to create more flexibility surrounding a return to the office, that we don't really know when it's going to be safe and when it's going to be comfortable to go. I think you're going to see more and more returns sooner and sooner as everybody's itching to get back to the office. But it's not going to be this, it'll be more gradual as opposed to this landslide of everybody's back in the office now and things are back to a new normal. It's going to be much more gradual. And because it's going to be much more gradual, it's going to be a little slower of a corporate transient recovery as well than we may have expected before, especially from an occupancy perspective or demand perspective, not necessarily from a pricing perspective. And one thing that we continue to highlight is the technology sector appears to be the slowest to return to office. They continue to be the most complacent about working remotely, and that looks like it will persist for an extended period. So something to keep in mind if you are looking at hotels in markets that have a lot of tech exposure. If you think about the utilization rates, it was slow and steady leading up to Omicron, right? This is data from Castle Systems, which actually tracks those people actually going into the office buildings. And you can see it was slow and steady leading up to Omicron. Then there was a big dip down related to Omicron, and we've since started to bounce back. And we're basically back to pretty much where we were back in October pre-Omicron. Momentum looks good, it's encouraging, but there isn't that spike back like we thought we would have seen by now pre-Omicron. So we'll come back, but I think because of the variants, it's just going to be more gradual. It's not going to be this big spike back. As we look at supply, virtually all temporary closed hotels have now reopened. There's no need to really discuss, which hotels remain closed, and there's only 1 or 2 markets where it's anything relevant. Opening delays continue to be material. First, there was the labor shortage. Then there was the challenges related to getting final inspections, and now you've got massive supply chain delays. And the Russia-Ukraine conflict has only made that harder, more challenging. Overall, we've got a 1.1% supply growth, economic supply growth metric in 2022, 1.5% in 2023. We focus on economic supply growth because it adjusts out temporary closures and reopenings, which we think creates a lot of noise in those numbers. We think this is a much better number to look at. So 1.1 and 1.5. Ultimately, we think supply will start to pick up in 2024, 2025, 2026, but it's still really benign. I mean, this is below historical averages over the next 5 years. So supply shouldn't be a real risk over the next few years. Here's our RevPAR model. I talked about us being transparent. This is us being transparent. The dark blue line that you see in this chart right here is STR's US RevPAR on a seasonally adjusted basis going back to 2000. The light blue line is the model that we have built to forecast that RevPAR, both historically and going forward. You can see the dip that we forecast for 1Q 2022 tied to the pandemic or tied to Omicron, followed by the snapback really aggressively and continuing that trend moving from where we were pre-Omicron moving forward. The drivers of our RevPAR model: unemployment rate, real GDP, business investment, foreign exchange rates. Notice no gas prices. These four drivers make up about 90% of all the variability in RevPAR in our model. So there are a few other drivers, but these are the ones that really matter, plain and simple. Next slide shows you the same thing, except we're looking at ADR. Here, R squared is 98.6%, highly accurate. Dark blue line is STR's seasonally adjusted US ADR on going back to 2000. Light blue is the model that we have built. You see how historically accurate it is. You see ADRs didn't take that dip that RevPAR did during Omicron. They're actually holding on and continuing to gain momentum. Here, business investment, consumer confidence, unemployment rate, and yes, inflation we have in our ADR model. Again, we don't think it's a huge driver, but we do include it. When we think about expenses and Ebitda, let's talk about wages a little bit. So wages have been elevated, as you can see, throughout 2021. We think they stay elevated in the first quarter, start to moderate, and then by 2023, you're looking at 5% growth, 4 to 5% growth thereafter. The most important thing that I would highlight about wage growth is that whatever gains wages made in 2021, 2022 are not going to be given back. These are staying, and I think that's important to keep in mind. Wages will stay elevated. Property taxes, we estimate, will grow at a 4.5% CAGR through 2026, and we use those factors coupled with inflationary costs and historical cost levels flexing to give us an overall Ebitda outlook. And what you'll see here is that we've got Ebitda continuing to recover, but by 2025, we actually have Ebitda growth slightly negative. We've got expenses outweighing revenue growth in 2025 and 2026, just modestly, but slightly. So Ebitda actually peaks in 2024. Our cap rate model, you can see right here, dark blue line is RCA cap rates, light blue line is the model that we've built, 98.3% R squared. The drivers of our cap rates: BAA bond yields, high yield bond spreads, foreign exchange rates, GDP, unemployment rate, lodging supply. The biggest factor, obviously, is BAA bond yields. When you're trying to forecast a US cap rate, that's the big factor. And I'll be honest with you, we don't know where BAA bond yields are really going to go. I wish I could tell you we did. At a market level, what we actually try to do is isolate out the BAA bond yields and focus on the local factors that drive cap rates to outperform or underperform the US average, which will give us confidence on a relative valuation as opposed to absolute valuation. But assuming the assumptions that we have in place for BAA bond yields, you get a cap rate. You get our cap rate model, which basically has cap rates rising slightly by 2026 from where they were in 2019, not aggressively, but slightly. And you put all that together, and you get our overall forecast summary here. And economic supply, as I highlighted in this year, will be 1.1%. We've got demand growing 5.5%, which leads to an occupancy increase of 4.4. We've got ADR up 13%, RevPAR up 18%, Ebitda up 57%, and values up almost 12%. Looking out 5 years relative to 2021, we've got supply up 1.8% per year, demand up 3.8%. OCC2, ADR 5.3, RevPAR 7.4, Ebitda very strong, and values continuing to increase on a 5-year basis. Bottom line is ADR and hotel values are going to recover this year on a calendar year basis. As I said, ADR we think basically is already recovered. Values pretty much have too. RevPAR and hotel Ebitda will reach 2019 levels in 2023. Occupancy will stabilize just below 2019 levels in 2023. And that's an important point to highlight. We talked about occupancy. We talked about corporate transient demand. We think it's a more gradual recovery. We also have a view that there's going to be a hybrid work environment moving forward. We're not talking about what you would call a hybrid, it maybe not be the right term, more flexible. This idea that people won't be forced to be in the office 5 days a week. There will be a little bit more flexibility in that. And when you see more flexibility tied to that, it will do a few different things. Number one, it's probably going to truncate corporate transient demand to, instead of 3 or 4 nights a week, to 2 or 3 nights a week across most markets. That will be negative for demand, positive for corporate transient pricing. It will also be, it'll be positive for leisure demand, where you've got more leisure travelers might take more weekends away and long weekends and things like that. I also think it'll be positive for group demand, where corporations will try to bring people together more frequently because they're not all in the office as much together. So net, we think it's a positive overall, but not a positive for corporate transient demand, which obviously is a big component of demand. So we're a little bit more cautious on the overall occupancy recovery, not necessarily ADR or RevPAR than what you see from anybody else. Key changes from our December outlook. It's really Omicron driven. We pulled back our 1Q-2022 outlook based on the impact from Omicron. Decline was offset by lower supply growth outlook and an improvement in ADR growth. Our 2022 RevPAR is literally almost the same as where it was in 2020 in December. It's 0.3% lower, and ADR actually is a little bit stronger, which is driving better Ebitda and values than we were a quarter ago. Now, if we go back to that hotel recovery timeline, I said I'd get back to that. As I mentioned before, values fell pretty precipitously during the Great Financial Crisis, and it took 8 years to recover back to prior peak levels. If you look at the light blue line here, light blue dashed line, which is the current cycle, our recovery is much, much faster, as you can see. We estimate that, as I said, values declined 24% in 2020, which will bring the total decline from the 2018 peak to 29%, which is pretty comparable to where it was in the last downturn. We think they snap back 22% in 2021, and are now just 7% below 2019 levels. We expect values to recover to 2019 levels this year, 2022, and to the 2018 peak next year, 2023. We think they'll peak in 2024, though, just 6% above 2019 levels. So we're not going to see the same level of peak over peak growth as we saw in the past. The recovery will be faster, but the peak will come faster, but it won't be as high. It'll be 6% above prior peak levels before values start to slightly decline in 2025 and 2026. That's what you see here, and that's tied to that Ebitda erosion that I pointed out earlier. So, outlook versus past cycles. As you think about the outlook versus past cycles, we do not expect occupancy to reach prior peak levels during this cycle, as I mentioned earlier. Therefore, you don't actually see occupancy here. But when you think about ADR, we've got ADR recovering to prior peak levels in 27 months. That is considerably faster than what we saw the prior two cycles, 45 and 52. And then RevPAR recovering in 39 months. That is also considerably faster, 1.5 to 2 years faster. And then values 3 years faster, 60 months versus 96 months. So our recovery is much, much faster than we've seen in past cycles, which is encouraging. And then one of the last things that I'd highlight to you guys before we get into the markets is our 2021 US forecast review. I think it's important to highlight this to anybody that's paying attention. So if you look at our December forecast, December 2020 forecast for 2021, back then on December 1, 2020, we said occupancy would be 56% in 2021, ADR would be 111.86, and RevPAR would be 62.59. Now, as we all know, 2021 was one of the hardest years to actually forecast for across the hotel industry. Nonetheless, our occupancy was well above anybody else. Nobody else was above 52.7. ADR, nobody else was above 109. And RevPAR, we were over 10% above anybody else. And we came in by far the closest. Now, in a normal environment, I'd tell you that being off by $13 in ADR is crazy, is way too much. But in 2021, when there was that much uncertainty and we were this much closer than everybody else, literally we were 13% off RevPAR in 24, 21, and 25 for the other big players, gives us confidence that we're doing things right and our process is working. Now, what I would highlight is that 10% off on ADR, which was closer than anybody else, we think it was really driven by the fact that we have not had a pandemic to model before for the hotel recovery. Our approach is very data driven, and without having the historical data related to our recovery out of the pandemic, we couldn't really model that. So we didn't really we couldn't really build out what the pricing would be like coming out. At the end of the day, the industry was much more resilient and much more aggressive with pricing, understanding that they couldn't induce demand in a health situation like the industry believes you can in an economically driven situation. And then as you think about our forecast versus everybody else moving forward, here's where our forecast is: occupancy, ADR, RevPAR moving forward. For 2022, we are again by far the highest in terms of ADR. We think ADR is going to continue to surprise to the upside, but we are much more cautious on occupancy, as you can see. Others have occupancy getting back to prior peak or relatively quickly, and we have it stabilizing far lower. And again, I highlighted why that is, but we'll see who's right in a couple of years, I guess. But we feel pretty confident in our numbers, at least based on what we know right now. That being said, let's walk through some markets before we go into Q&A. So here's the 44 markets that we issue quarterly reports on. We do a lot of work on commission basis on other markets, but these are the 44 that we issue quarterly reports on. So we're going to focus on these right now. 2022 outlook. When you think about RevPAR, the base year really matters. You're comparing 2022 versus 2021 or comparing it versus 2019. San Jose and San Francisco should have some of the strongest RevPAR growth in 2022 relative to 2021. But relative to 2019, they're still the two at the worst. So understanding those dynamics is really important. Overall, we think the right way to think about things right now is relative to 2019 still. At some point that's going to change, but right now we're pretty focused on relative to 2019. And what you see in that dynamic is top performers: Norfolk, Tampa, Miami, and Charleston. Bottom performers: San Francisco, San Jose, New York, and Chicago. Base year matters, as I just mentioned. This is an interesting chart that I put together. The further up the chart you go, the stronger the RevPAR growth is relative to 2021. The further to the right you go, the stronger the RevPAR growth is relative to 2019, looking out to 2026. So what you see is this little guy, this loner right here, really strong RevPAR relative to 2021, 160% above in 2026. But relative to 2019, he's actually negative, right? He's actually the only guy negative. That's San Francisco right there. We were pretty cautious looking at the 2019. So really strong growth over the next 5 years, but still negative relative to 2019. Then you get guys like these guys over here, which I believe are Miami and Tampa, which are really strong growth relative to 2019, the strongest, but relative to 2021, their growth is much more muted than most of these other guys, right? So just understanding those dynamics, I think, can be particularly important. Our top performers for 2026 versus 2021 are going to be markets that really lagged in 2021 and 2020, and the bottom performers will be those that basically have been solid performers at the start of the recovery, but lack a lot of economic growth moving forward. And then relative to 2019, the top performers are going to be those that had outsized leisure exposure, strong demand at the start of the recovery, and the bottom performers will be those that had a sluggish recovery and don't have outsized economic growth as well. If you think about RevPAR back to 2019 levels and then thereafter, it's important to understand that not every market's going to be the same. Just because a market recovers quickly doesn't mean it's going to outperform thereafter. And in many cases, they might recover quickly and then languish or even decline. So understanding those nuances is important. We estimate that of the 44 markets that we track, 3 already recovered on RevPAR to 2019 levels. 5 will be there in 2022, 26 in 2023, 9 in 2024, and 1 a year later, or 1 later. And then if you look at this chart down at the bottom, what you'll see is when the market recovers and where it will be relative to 2019 in 2026. And what you'll see is there are going to be markets that recover early on, 2022 here, but by 2026, they're actually underperforming all these other markets that are recovering later. And then there will be markets that recover later that outperform markets that recovered earlier. So understanding those dynamics, I think, is important. Recovery early isn't necessarily the only thing you care about. So as we look at RevPAR 2026 versus 2019, This is our outlook. San Francisco is the only market that we think does not fully recover to 2019 levels by 2026 in terms of RevPAR. Every other market we think gets back there, but the U.S. will be much stronger, right? Than a bunch of these markets. Miami, Tampa, Vegas, Memphis, and Norfolk are our favorite markets for RevPAR growth relative to 2019. If you look at hotel values, which is a little bit different, and we look at 2026 versus 2019, it's Tampa, LA, Phoenix, Nashville, and Denver, because we're taking into account what we think is happening with cap rates, what we think is happening with expenses, the mix between ADR and occupancy, all these other factors. And these are the markets that we like the most there. And then in terms of sentiment shifts, where have we gotten more bullish or more bearish? We've gotten more positive on Houston, Norfolk, and Orlando. Houston, we've talked a little bit about energy. It's all about energy. And energy employment, natural gas production. These are all factors that drive our Houston outlook, and those have improved. Norfolk, at the end of the day, the outsized leisure exposure will move our numbers across the market in 2022. We continue to believe that values will peak in 2022 or early 2023, but we don't forecast the same level of steep decline we had before. Orlando, difference is really just tied to the later years of our forecast, where the outlook for Orlando's economic growth in 25 and 26 is stronger than it was a quarter ago. Deteriorating outlooks, Nashville and Anaheim. Nashville, I want to caveat this. Nashville is still one of our favorite markets. We've lowered our value outlook, but it's all driven by 2026, and it's still a top 5 performer. Just not quite as robust as it was. Just, lots of robust instead of ridiculously robust. Still very positive. We think that's a great market. Anaheim, same thing, also entirely driven by 2026 economic outlook, but still a very strong performer. And with that, to give people a sense of how our pricing works, if you're ever interested in contacting us about a report or a contract, this is our standard pricing. The more you buy, the more you save. You've all heard that before, but I'm not going to try to be salesy here. So I'm going to stop there and turn it over to Katie for Q&A. How are we doing, Katie?
Good. Excited to start the Q&A. So first question, any concern regarding inflation, Russian war, and market sentiment preventing pent-up demand continuing on its path in 2022?
Yeah, I mean, I think we addressed most of that. That was probably a question that came out early in the presentation. At the end of the day, if the war persists, it will weigh on supply chains, which will be an issue for economic growth, which will hurt demand. I think it will also weigh on those gateway markets that attract inbound international European travelers, as we talked about, and it could be a positive for Houston and other energy-oriented markets like that. Regarding inflation we don't think is as big of a concern relating to leisure demand. The gross savings rates are at an all-time high, so that's less of a concern. Gas prices could be a little bit of a concern, but we think it's more on the margin. So we're not overly worried about it yet, but we do think it could shift demand from that leisure destination that's a 5-hour drive from a population center to a leisure destination that's a 1-hour drive from a population center. So it's worth keeping that in mind.
Is it fair to say that majority of the ADR growth and RevPAR growth is as a result of inflation and not real pricing power?
Absolutely not. We're seeing ADR growth considerably above where we've seen it in past recoveries. And in past recoveries, inflation was still 2 to 3%. We're only talking 4 or 5%. We're talking, 6% range right now for 2021. Less than that for 2022 is the outlook right now. So our ADR recovery is much stronger. It's not inflation driven at all.
What constitutes hotel comparable home sharing? Is that Airbnb? Any color would be helpful.
Yeah, so it includes Airbnbs and PRBOs and a handful of other Sonder and the like. It's an AirDNA metric, basically whole unit, studio, 1-bedroom, 2-bedroom accommodations that are rented out on those types of online platforms. It is not the 6-bedroom house. It is not the guy renting his couch. It is something more comparable.
How will gas prices impact other supply chain logistic issues? An example, flight prices, higher renovation costs, higher COGS.
Yeah, I mean, I think those are all things that we're seeing, and it's part of inflation, it's part of gas prices, all of the above. There's no doubt about it that gas prices are going to continue to impact those things. And frankly, supply chain issues related to those gas prices are going to continue to delay openings and renovations, which are going to be a factor.
Didn't Google announce that return to office in April?
Google did. They are one company that did. That is correct.
Can you talk
across
about
all their locations too.
Can you talk about what you are forecasting and or seeing for the San Francisco market moving forward? It seems that the pandemic just highly accelerated what we were seeing here beforehand, which is leisure and corporate travel as well as conventions decreasing due to people having poor experiences with the homeless. Where do you see San Francisco Bay Area going? Do you expect occupancy and ADR getting back to pre-pandemic levels? Thank you.
Good questions. So I think everything you just said is probably spot on. I think San Francisco is one of those markets that has outsized exposure to their convention center, Moscone. Other markets would be San Diego, Chicago, New Orleans as examples. They generate an outsized amount of demand. Moscone generates an outside level of demand. And when the convention center pacing is weak, it really impacts the market. Moscone's pacing started to slow in, I would say, 2016, 2017, 2018, certainly pre-pandemic. And that was largely tied to the homelessness issue. That has been a major concern across that market. Because of that, over the next 5 years, we have 1 year, 2023, where San Francisco is pacing anywhere near 2019 levels. The rest of them are all down like over 20%. That's a bad situation for San Francisco. You layer in the tech exposure, which we think is a slower recovery, the high cost structure of San Francisco, and that's not a recipe for a market that we think is going to really thrive. We don't think occupancy gets back to 2019 levels during this cycle, but we don't think occupancy across the US gets back to 2019 levels during this cycle. So that's a relative call. We still think occupancy will stabilize north of 75% in San Francisco. So by no means is it bad. ADR, we think finally on a nominal basis gets back to 2019 levels in 2026. Long way off, but RevPAR is still not there.
Giving all the performance metrics combined with continued COVID and Russia-Ukraine issues, is there any comment on how this will impact hotel development pipelines? Lending seems to be loosening, but building costs are skyrocketing. How will all of this impact the future of new supply?
Yeah, I mean, that's a great question. I think supply remains muted for a while. Lending is there. Lending's been there for a little while, actually. Lending in this cycle isn't the challenge for development. The challenge is more construction costs and timelines and schedules, which seem to be harder and harder, and whether there's a better use for the real estate than hotels, which in certain markets may be the case. So it's a combination of all of that. At the end of the day, all of this has an impact. I think the supply chain issues and increased construction costs will continue to limit supply, which we think will stay muted, as we highlighted, over the next few years.
Hoping you can share your slides. I had an overlapping meeting in this first half hour.
Yep, as we said before, we will share the slides, so don't worry.
Curious what rationale is associated with your view that cap rates for hotels will only increase modestly over the projection period. What is your view of interest rates and inflation over that period?
Sure. So a couple things. We think interest rates are going to climb pretty sizably over the next 5 years. But what drives cap rates isn't just the rising base rate, it's also the spread to that base rate. And when interest rates are rising, because there's solid economic growth, like we think there will be over the next few years, it translates into compressing spreads, which is a positive for hotel cap rates. When you're dealing with inflation, you see two positives, as I talked about earlier, related to cap rates. Number one is you see a flight to hard assets. Number two is you see a flight to the perception of hotels being more inflation resilient because they can reprice daily. So even within the flight to hard assets, you see a flight to hotels. All of that is positive. With the level of capital that has been raised to fund hotels, we continue to think that you will see a strong appetite for hotel investment. Therefore, you'll continue to see spreads compress regardless where base rates are. And as a result, we only forecast about 20 basis points of cap rate expansion over the next 5 years.
And I believe this is the last question. Can you speak to any distinctions you may be seeing between trends for leisure stays versus business travel stays? It seems that different factors may be at play, thinking especially about companies rethinking previous notions about the necessity for employee travel and budgets.
Yeah, I mean, I think I addressed a lot of this earlier. There's obviously a huge disparity between leisure and corporate transient travel right now. And I think that disparity is going to continue to play out. There is a tremendous amount of appetite for leisure travel. It's hard to call it continued pent-up demand because it's been, it's no longer been pent up for the last 6 to 9 months, right? As everybody's been traveling so much from a leisure perspective. I think there's still a lot of pent-up corporate travel demand. where people want to get out and travel and meet and do all that. I think the biggest factors that drive corporate travel are not CFOs and controlling budgets, it's stock prices. If stock prices are high and your multiples are expanded, you have to justify that multiple by growing into it. To grow into it, you cannot cut costs. You have to generate revenues. Generating revenues usually requires getting out and traveling. Do I think there's going to be the same level of corporate travel demand as there has been in the past? Absolutely not. I think we're seeing a truncated number of days a week that are going to be corporate travel oriented going forward. Instead of there being 3 or 4, it's going to be 2 or 3, and those shoulder days are going to be a mix of leisure and corporate travel with less demand. So that's why we have a little bit more of a cautious view on occupancy than some of our peers out there. But it's also why we have a little bit more of an aggressive view on rate, because we think you get much more pricing power during those compression nights when all the corporate travel is truncated into 2 or 3 nights.
We did get one more question. What is the reasoning for hotel values after they reach their peak?
We have hotel values declining after the peak in 2025 and 2026. It's based on, at that point, we have cost growth exceeding revenue growth. And the revenue growth metrics are just pulling back as economic growth slows. It's just that simple.
And I believe that is the last question as of right now.
All right. Thank you very much. If you guys have any questions or need anything else, feel free to reach out to me. You can email information at Lark Analytics. I'm happy to help in any way we can. And as I said, we will send out the PowerPoint hopefully later today. Thanks so much and have a great day.
Thank you.